Hello everyone, how are you all? I'm Dr. Labib from Dr. Labib Academy. Okay, today we are going to have ACCA SBR Strategic Business Reporting. This is chapter 5. Okay, this is chapter 5. We have done non-current assets. Is it right? Non-current assets. This is in the series 11. Okay, this is in the series 11. I kindly request you all, please subscribe to my channel, share this channel, post your comments, and anything is there, please let me know how best we can improve, and just watch till the end, and anything is there, please let me know. Okay, please subscribe to my channel, share the channel so that everyone who is can benefit it. That's very important for us. Coming back to this, right, we have done till now investment property, we have done borrowing cost, we have done IAS 60, is it? We have done various things. We are going to cover something with respect to research and development expenditure. Right? When we say it is a research and development expenditure, make it a point. See, research and development should be separated. Okay, there is big difference between them. We have done in F7, we have done this research and development. It is the extension of that only. Okay, research should be expense and development should be capitalized. That development should be so we have to draw a line which one is the research expenditure, and which one is the development. Anything with research is in the process. Okay, research will be successful, research will not be successful, but development is what? Development is once we are succeeding the things, we are successful in doing the things, and subsequently it will be progress further. Okay, so that is the basic difference between research and development. Research is defined as an original and planned investigation undertaken with the prospect of gaining some scientific or technical knowledge. That is what the research talks about. We are talking with investigation in process. Yeah? Research expenditures cannot be recognized as an intangible asset. Very, very clearly defined. It cannot be recognized as a, although tangible assets used research should be recognized as a property, plant and equipment. But technically speaking, or financially speaking, research expenditure cannot be recognized as a. What is the development? See the thing. This is the basic difference between the research and the development. Okay, development is defined as an application. We are successful. We have got success, and we can progress further, or of research findings or knowledge to plan and design for the production of new or substantially improved material. Means when we are talking about the, see, this is with respect to IAS 38 para 8. Okay, there is a code difference between research and development. What it says that or services before the start of commercial production or use. Means if it is development, there will be a cash component. Is it? Future cash flows will be there. Is it? It will contribute. IAS 38 says that development expenditure must be recognized as an intangible asset. The development, whenever we are talking, we have to identify it as an intangible asset. What criteria when it has to be demonstrated? It should be technically feasible. Yes, it's nothing but it is going to have a proper approvals. Okay, the entity intends to complete that intangible asset, and we can use it or we can sell it. Okay, this is very, very specific. And whenever we say it is an asset, it should generate future economic benefits, and it is adequate resources to companies. You should not you should not leave the project in the middle. Okay, you have to continue it with the till the end, and it can reliably measure the expenditure on the project. Means definitely what you are doing, we are taking into consideration the matching concept. Is it right? We are taking into consideration the matching concept as such. Here you have to match the income with expenses. What it says, very in a very simple way. Okay, during the year 31st December 2001, spent score how much? 2 million on the research and development in the project. The entity has recognized all 2 million as an intangible asset. But they have spent 2 million and they have recognized 2 million as an intangible. When they have given the breakdown, see the things, how the breakdown is working. Research into materials 0.5, market research 0.4, employee training 2, development activities. Is it right? Now, when we are talking about the thing, when we have which one we have to take and which one we should not take, that's very important. Is it? When we are saying it is we are talking about the expenditure on research, market research, and the employee training. Is it right? The research, what they say, the entity has recognized as an intangible asset. The expenditure on development activities were incurred evenly over the year. It was not until May 1st that market research indicated that the product is likely to be profitable. At the reporting date, the product development was not yet complete. Is that at the reporting date, it is not complete. Okay, if it is not completed, then how we have to treat it? Okay, how we have to treat the things as such. Right? In order to make sure that what we have to do, expenditure on research, still make it a point that the product is not yet complete. Is it? And how much they have made a development on development activities? 0.9. Okay, on development activities it is how much? It is 0.9. The expenditure of development was incurred evenly. It was not until 1st of May market research indicated that product will be likely to be profitable. Fine, it is likely to be profitable. Means how much is there for how many months? It was not until, means it is going to be how many months? It is going to be initial 4 months from 1st of January 2001. Is it right? For 1st of January 2001 to 1st of May 2001. Okay, January, February, March and April. Fine. Okay, now what we have to take and what we should not take, and what it has to be expensed. Okay, according to the requirements. Right? Now, make it a point. Still, it is not completed. Solution I am writing here. Okay, I am explaining here on this side. Is it? What it says, see, it is not complete. Means what we have to take. What is the options? What is to be categorized as research, and what is going to be categorized as development? Okay, what is going to be categorized as? See, research is what are the expenses? You have expenditure, research in materials, is it right? This material, research into materials, is it right? Research into materials. How much is there? 0.5. Okay, marketing research. How much is there? 0.4. Employee training will never be a part of this. Okay, employee training is never ever be part of this. How much is there? 0.2. Fine. How much is there? 0.2. If you add this one, is that if you add this one, how much will come? It will come to 1.1. Okay, it will 1. What is the development expenditure? How much they have spent development activities on the development activities? 0.9. Okay, 0.9, and 0.9 it is for how many months? It was not until when you have to capitalize by 1st of March. Is it right? Once it is done, means how many months? 4 months. 4 by 12. It comes to how much? 0.3. Is it? 0.3 is the research cost. Okay. 0.3 is the in the development activities. Out of this 9, okay, out of this 9, how much is it? How much is 0.9 is to be expensed, okay, and 0.6. Fine. Now we have to make a separation on this. Fine. What happens? See, when you are expensing, all these are going to be expensed. Okay. Research is what? Research is profit and loss account. Fine. This has to be added to here. Is it 0.3? Fine. 0.3. It comes to how much? 1.4 million. Is it? In 1.4 million. This has to be expensed. Okay. This is the research expenses. Okay. Research expenses. What you have to write the journal entry? We have to write the journal entry as debit is what? Debit is the, when you are expensing, debit is the profit and loss account. Is it right? Debit is the profit and loss account 1.4 million. Credit will be what? Credit will be intangible assets. Why we are taking this? We are giving intangible assets credit because they have recognized it as a intangible asset. Is it? Okay, how much? 1.4 million. Is it? Now, how much we have reduced the intangible asset? How much you have to show? This, see, this is going to be shown in the profit and loss account. How much you have to show in the statement of financial position? How much is the intangible assets? Intangible assets which they have shown in the balance sheet is how much? Intangible assets is 2 million. Okay. Now, how much we have expensed profit and loss account? We have expensed how much? 1.4 million. How much is the intangible assets? Intangible assets to be shown. Is it right? Intangible assets to be shown in statement of financial position. How much? 0.6 million. Okay. Like this, you have to be very clear about the where which have to be expended. Every standard will have the same structure. Definition will be there, methods will be there, application will be there, and disclosure will be there. The amount of research expenditure in the product is, we have to know with respect to what amortization methods used. Is that very important? When you see why we are talking about amortization? Amortization method is used wherever there is a finite life. For intangible assets having an indefinite life, the reason supporting the assessment, we have to give justification. Okay, we have to give justification for the indefinite life. The date of any if there is any revaluation, we have to mention the methods and its assumption. And in the end, always make it a point, there should be a reconciliation should be there at the beginning and the end of the period. Fine. That's one of the things. Next, this is with respect to what? This is with respect to the research and development. Coming back to the next one, another accounting standard impairment. It is also one of the most important aspect. Impairment is the reduction in the recoverable amount of the assets below the. See what will happen? Carrying amount. Is it right? Carrying amount will be how much? Carrying amount will be 100,000. Is it right? Carrying amount will be 10,000. What will happen? The value of what we are going to realize, the value will be less than the carrying amount. Is it? If it is less than the carrying amount, then it is going to be called as an impairment asset. Now, in impairment assets, what we are doing is we are adding one more thing. What it says, what is a cash generating unit? Is it? We will work on this in detail. There will be one question for 2 or 3 marks will be there on this. Is it? 2 or 3 marks. Impairment of assets says that entity should carry out the impairment. If there is an impairment, we have to carry out annually. This is the most common way of putting the things. Is it? In every way. If you are doing, we have to do it annually. An intangible asset is not being amortized because it has a indefinite useful life. That intangible assets is not going to be amortized. Okay, amortize. What is the amortization? Amortization is nothing but you have a finite life. Goodwill has arisen on a business count. Internally generated goodwill should not be recognized. Is that externally generated? IFRS 3. We will cover this. The moment we are talking about IFRS 3 at a later stage, we will go in detail. Okay. Now, what are the reasons of impairment? Is it right? Definitely, impairment is the value of the asset is decreasing below the carrying amount. So many things are there. You have the external sources, you have the internal sources. Okay. You have they will not ask, but for our understanding. Unexpected decrease in market value. Okay, there is adverse changes that have taken place in terms of technology, market, economic and legal environment. If the rate of interest is increasing, what will happen? The value of the asset will decrease. Is that asset recoverables? Is that if the rate of interest is increasing, what will happen? Value of R increases, present value will decrease. The entity net assets are measured more than its market value. Sometimes what will happen? They will be overpricing. Internal sources in terms of obsolescence or damage. There is about to be a medical reduction in usage of the asset. Is that we are not using the things appropriately and as per the specifications. Evidence that the economic performance of the asset has been or will be worse than economic performance. We are expecting some performance, but that performance is because of technology, because of obsolescence, because of the materials, because of the demand and supply. There are so many things, isn't it? It's very, very generic in nature. How we have to calculate the impairment loss occurs if the carrying amount, see always they say, of the carrying amount of an asset is greater than recoverable amount. Carrying amount is 100,000, recoverable amount is 75,000. Then there is a impairment of how much? Impairment of the recoverable amount is higher of fair values, less cost to sell or value to use also. This is the definition for recover. What is the recoverable? Is higher of the fair value, less any cost to sell or expenses. Okay? Now, what is the fair value? Fair value, we have done this. Fair value is nothing but we are in an orderly transaction between market participants at the measurement date. Yeah, it should be an orderly transaction. That's the fair value, how it is. Definitely there is some cost to sell. To sell the asset, we will have incremental costs which are directly attributed. What is the value in use? this is another important element, is calculated by estimating future cash inflows and outflows. Estimating future cash in from the use of the asset and its ultimate, the last disposal, and applying suitable discount rate for means value use is nothing but we have to take into consideration the inflows, we have to take into consideration into the outflows, and we have to take into consideration any disposable values, is it right? Disposable values. On this we have to calculate with respect to the discount rate. What right with regard to the estimates of cash flows? IAS 36 has prescribed a very structured criteria for the cash flow. The cash flow projection should be based on reasonable assumptions. The cash flow projection should relate to the asset current condition. If you are having a cash flow in excess of 5 years, management should extrapolate from early. Means, see what happens when you are estimating. We are analyzing the last 5 years, is it right? And we are estimating the next budget, estimating the next 5 years. Yeah, the discount, and how we have to use the discount rate. Discount rate is nothing but the in terms of time value, the risk specific to the asset. See, every asset will have a different discount rate. Cars will have a different discount rate. IT products will have a different discount rates. Is that you will have every product. Is that you are talking about car, you are talking about the aircrafts. Is that we are working with respect to the technological products. Is it right? We are talking in terms of gadgets. Is that every category will have a different discount rates as such. Yeah? When you do the thing, see the thing here, you have to be very clear. You have to compare carrying amount and recoverable amount. Fine, amount of higher amount, which is higher amount, whether fair value less cost to sell or value in use. See what it says. If fair value less cost to sell is higher than carrying amount, there is no impairment. Is right? If fair value is less, cost to sell is having the higher than the carrying amount. If it is 150 and it is 100, okay, if there is no impairment, no need to calculate. Definitely impairment occurs when it occurs when the carrying amount is more. Is it right? Impairment occurs when the carrying amount is 155 and the fair value is 145. It is less. Is it right? It is less. In this case, impairment will occur. Whereas in this case, there is no impairment. Fine? Test your understanding. See, these are the things which you have to do. How we have to estimate the cash flows. Okay? How we have to estimate. What it says, the finance director has asked the accountant to perform an impairment test on the assets of John for the year ended 31st December using the most recent financial forecast as the basis of fair value in use calculation. The realized cash flows for the entity were negative in 2005. Is that means see the things. They are talking in terms of for the year ended 1/1/2005 to 31/12/2005. Is that here what's happening? Here the cash flows are negative. Okay, cash flows are negative. Very clear. Put the things unless until you don't write it on the paper, you will not understand. I kindly request you to subscribe to my channel and share this channel. Fine. And far below the cash flows for that period. The director have significantly raised the cash flows with little justification. The projected cash flows has been kept. Means what happens here? It is negative, is it right? Here it is negative. It is going like this. This is the graph. Okay, it is negative. Immediately after, from 2006 onwards, is it right? 2006 onwards, they have increased the cash flows. Okay, they have increased the cash flows. The projected cash flows calculated by adding back the depreciation charges to the budgeted results and with expected changes in working capital and capital expenditure not taken into account. Means they have the accuracy level is missing. Is it right? The assumptions are not as per the requirement. Fine. The assumptions are not as per the requirement. If we are going to say that the assumptions are not as per the requirement, they means the first one is it is not an best estimate. Is it right? It is not the best estimate of the economic activities. Now what it says, the assumptions are also different. Is it right? Their assumptions, by examining the difference between past cash flows and the assumptions are not justifiable. Fine. Apart from that, there should be a consistency. Is it right? There should be a consistency. See, when you in the year 2005, when it is a negative cash flow, how can you have a turnaround? Is that you cannot have a turnaround with respect to immediately you will have. There will be a slow and sustainable growth. Is it right? Consistency is also miscalculated. Is it right? These are the things are there. Is it right? Now, estimates of it should be what we have to include. That's very important. Is that we have to make sure that whatever is there. See, this is the way the cash. These are the points which you have to take. Is it right? These are the points which you have to take into consideration whenever we are thinking and we are planning the cash flows. When we are planning the cash flows, means projections of we have to make projections reasonably. Is it right? Projections of cash flows is in terms of what? Continuing use of asset. Okay, I'm using Kaplan. Okay, I'm using Kaplan and I'm using it in a sequential way, and this is the 11th in series. Okay, I'm giving you 11th in. I follow the series continuously. Don't skip. Okay, don't skip the things. Don't keep track of where you are heading. Okay, next, projections of which are necessarily incurred in generate the cash flows, means what happens. Use the projections. Is it right? Projections of cash outflows. Is there projections of cash outflows and inflows? Is it right? And cash inflows should be in line. Okay, should be in line. I can put like this. Okay, and next, fine. Now you can understand how it is going to be. Is it next? We have to when we are making things cash outflows. Is it? It should be very clear. Include the future cash inflows and the level of economic benefits. Is it? Future cash inflows and economic benefits. Economic, you see, this is what is a opportunity cost. Is that it has to take into consideration opportunity cost. It has to take into consideration the time value of money. Is that when we are making the future estimates, we have to take as many variables as possible to have a best estimate. Okay. Now, that's very important. Okay, that's very important with respect to the, and they have what they have said. The projected cash flows has been calculated by adding back depreciation, is it, charges to the budgeted results for the period with expected changes in the working capital and capital expenditure not taken into account. We cannot miss the things as per our convenience. Okay, that is where we unless until we cannot do that, we cannot make that there is a impairment review as per IFRS 36. Recognizing impairment losses, how you have to recognize. See, if the is normally charged immediately to the profit and loss account and other comprehensive income. This has to be noted into consideration. They will ask you this. They will ask you this in when it is going to be in the exam, in the question they will ask. Okay, if the assets are previously revalued upward, the impairment as a component of other OCI and is debited to the revaluation reserve. Means if there is any surplus is there, from the surplus we have to deduct. Okay, the remainder of impairment loss is recognized in the profit. First we have to use the surplus account. The remaining carrying amount of the asset is depreciated or amortized over its useful life. Fine. This is the basic process where there is a impairment of the assets will be treated in the both financial statements as such. They gave you a small question. Okay, test your understanding. See, first I will complete all the chapters, test your understanding. Okay, then I will start the thing somewhere by the end of once it has been done. Okay, but make it sure without this just going directly to and solving the questions, it will be a very tough to understand. Okay, if you have clear thoughts here, automatically clear understanding, you can do as many questions as possible. Fine. On 31st December, entity noticed that one of its plant and machinery is often left idle. This is what happened on 31st December 2001. On this date, asset carrying amount is how much? The carrying amount is how much? The carrying amount is 500,000. What is the fair value? The fair value is how much? See, carrying amount is more, fair value is less. Okay, carrying amount is more fair. The cost estimated, see, cost to sell, is it right? Cost to sell is how much? 25,000. Is right? Cost to sell is how much? 25,000. If the asset is not sold, the entity estimate that it will generate a cash inflows of how much? It will generate, if it is not sold, the entity estimate that it will generate a cash flows of how much? 200,000 in the next 2 years. Assume that the cash flows incur at the end of each year. The discount rate is how much? The discount rate is 10%. What they are asking us, discuss the accounting treatment of the above in the financial statements 31st December. How would the answer to part 1 be different if the balance of 10,000 in other component of equity relating to clear revaluation of this specific asset? There are two parts. Okay, the first one is we have to see what is the accounting. See what they say, there is a cash, they are generating a cash flow. See, is it right? They are generating a cash flow of how much? 200,000 for first 2 years at the rate of how much? 10%. First we will calculate what is the present value of these cash flows. Once we have the present value of these cash flows, then we will see how much it is a impairment. Okay, how much it is the impairment. What we are doing, point number A, is that point number A. present value, the present value of assets future cash flow. Very simple, it's not difficult. Okay, it is not difficult. Here where there is a difficulty, I will tell you. Is it right? Cash flow, but we have the discount factor. Is it right? Present value of cash flows. Here 1 and 2, 200 and 200. Is it right? Here what is 1 divided by 1.10 to the power of 1, 1 divided by 1.10 to the power of 2. Is it right? This is column 1, this is column 2, this is column 3, this is column 4. 2 times 3. Okay? 2 times 3. Fine. How much is it? 0.909. Is it right? It comes to how much? 200 divided by 1.1, it comes to 182. It is in thousands. Okay? It is in thousands. You have to write when we are doing 200 into 1.10 to the power of 2. It comes to how much? Don't take decimals. Okay? You don't take decimals. It comes to how much? 347. Is it right? Now, next, what we have to see? Put it as step 1. Okay? Put it as step 1. Is it? Put it as step 1. Next, step 2. Okay? Next, step 2. Step 2 is what? We have to take the recoverable amount. Is it right? We have to know what is the recoverable amount. Is the less cost to sell. Is it right? What is and the value of use. Is that this is value in use. How much is the value in use is how much? It now. That fair value minus cost to sell. Okay, how much is the fair value? Fair value they have mentioned. How much? The fair value is 325. Cost to sell is how much? Cost to sell is 25. Okay, how much is there? 300. Value is in use how much? Value in use is 347. Is that value is in use is value is in use is 347. Fine. And the fair value less cost to sell is how much? It is 300. Carrying amount is how much? See, carrying amount is how much? Carrying amount is 500. Value in use is how much? Value in use is 347. Is it right? Impairment is how much? Impairment carrying amount is more. Okay, carrying amount is how much? 500. Is that carrying amount is how much? 500. Value in is how much? Value in use is how much? We have to take the higher of that. Okay, we have to take the higher of the value. Okay, the recoverable amount is the higher of the fair value less cost to sell. How much is there? 347. Is that 347? Difference is how much? Difference is 153. Is that difference is how much? 153. This 153 is going to be identified as impairment. Is it? What is the general entry of this? General entry will be profit and loss account. Profit and loss account is how much? 153. Asset value has decreased, is it right? Debit profit and loss account. Credit property, plant and equipment. How much? 153. Okay, this is the part 1. Fine. What is the part 2? Part 2 is how much? What they are saying? They are saying that if there is a balance of 10,000, is it right? How much is the impairment? Impairment is how much? Impairment is 153. Okay, impairment is 153. How much we can take the advantage of a balance? Is it? Balance is how much? Balance in other components of equity, OCE. How much is there? 10,000. Okay, 10,000, 143. Is it right? 143. This 143 has to be debited to profit and loss account. Okay, if that is the case, what we have to write? General entry. General entry is debit profit and loss account 143. Okay, debit other comprehensive income 10,000. Is it right? And credit is property, plant and equipment 153,000. Simple one. Okay, it's the very simplest way. But see the things. All these, it will be for 2 marks. It will be for how much? It will be for 2 marks maximum, not more than that. We are doing another new one. It is a cash generating unit, CGU. What is the cash generating units? Okay, it is the smallest identifiable entity. It is not usually possible to identify cash flows relating to. For example, a factory production is lined with many individual machines, but we don't know how it is workable. A cash generated unit is the smallest group of assets that generates independent cash flows. Is it? It is the smallest unit. Is it? You have so many units will be there. Is it? You divide these units into various. It is the smallest unit which is going to be called as a cash generated. Okay, this is what it says. Test what it says that an entity has 3 stages of production. Okay, growing and felling trees, creating parts of wooden furniture, assembling the parts from B to finished products. Is it? What they want to say that what is the smallest unit? Is it? What? Creating parts of wooden furniture. Okay, it is, see, growing and felling trees. It's a big unit. Is it right? Growing and felling trees is growing and felling trees is a external. Is it right? It is a macro component. Okay, creating parts for wooden furniture is a small identifiable unit. Assembling the parts from B, okay, we are taking the parts from B, it is also going to be identified as a small identifiable unit. The output of A is timber that is partly transferred to B and partly sold in the external market. If A did not exist, B could buy timber from the market. Means what happened? A is not only doing generating from the external sources, but A is also providing inputs to the process B. The output we have no external market, see the thing, and is transferred to C at a internal process. Means this is, we can understand by its nature, it is the smallest unit as such. C sell the finished products external market, and it is sales achieved by C is not affected by the fact that three stages of production are performed by the entity. Is it? Now you see the thing. When you are making a point, the output of B has no external market and is transferred to what? Is transferred to the internal transfer. See, whenever there is a transfer, is it right? The transfer should be done on a market price. Is it? The transfer has been done on a market price. If you take that above things into consideration, is it right? If we take above things into consideration, we can assume that based on the information it has been provided, A, B, and C, it is our assumption that B and C are the smallest units as such, and those are going to be identified as a, is it a cash generated units as such. Now what happens, how we have to value it? Is it a allocation of a, see, whenever, see what happens, this is directly related to the impairment. Okay, whenever the impairment happens, immediately the first thing is it will affect the goodwill, which does not generate cash flows independently. Because why it is affecting goodwill? It will not generate cash flow independently. Goodwill in collaboration with the tangible assets, it will generate cash flows. We cannot say that goodwill is a cash generating unit as such. Corporate assets that are used by several cash generated units, the assets that are used by several cash generated units, they do not generate their own cash inflows, so do not themselves qualify as cash generating. Means we should not treat head office buildings or a research center, is it right? They means they are not generating from their own, they are dependable. Okay, even goodwill is dependable. Fine. So you have to be little bit careful. Corporate assets and goodwill should be allocated to cash generated asset units on a reasonable and consistent basis. That means you have to be very, very sensitive with respect to corporate assets and goodwill. A cash generated unit to which goodwill has been allocated must be tested impairment annually. Means you have to have a close watch on goodwill. Fine, close watch on goodwill when there is a impairment, because it directly and it straight away impacts the goodwill as such. Is that it? Straight away the impairment. See what they are giving very clear guidelines for us. If an impairment loss arises in respect of cash generated units, it requires to allocate among the assets in the following order. If there is an impairment loss, first it will have impact on what? It will have impact on the goodwill. Okay, it will have impact on the goodwill. As simple. Straight away we have to reduce the goodwill. Other assets in proportion to the carrying amount, pro rata basis. Is it a pro rata basis? We have to take into consideration. However, the carrying amount of the asset cannot be reduced below the, as simple as that. If the carrying amount is 100,000, you cannot reduce the asset by 110,000. Okay, you cannot reduce by 110,000. If maximum how much we can reduce? We can reduce by 1,000. what not by 110,000. Fair value less cost to sell, what is the value in use. Okay, means these are the terms and conditions which you have to take into consideration. There again, Tyner has identified an impairment loss of how much? 41 million. One of the carrying amount of the net assets are how much? 150,000. Okay, carrying amount loss is how much? The impairment loss is it? The impairment loss is how much? Impairment loss is 41 million. Carrying amount is how much? Right? Carrying amount is 150 million. These are very interesting. Is that whereas the unit recoverable amount is how much? Recoverable amount is recoverable. This is one of the easiest section, okay, where we can score marks. The draft values of the assets have been given. Goodwill is there, property, machinery, vehicles, patents, and non-monetary assets. The value will never decrease. Okay, at least the historical price will never decrease. All these are historical prices. The net selling price of the unit assets are insignificant except property, which is having how much? 35 million. The net monetary assets will be realized in full always. Okay, always this condition will, unless until they have told us specifically, we are not going to change this. Okay, we are not going to change this as such. Is it? We are not going to see what happens. See the thing. What it says, first what will happen? Goodwill. See the thing. Firstly, the impairment is allocated to the goodwill. Goodwill will become 0. Okay. Next, the impairment loss cannot be set against profit because it is net selling price is greater than the carrying amount. Carrying amount is how much? Carrying amount is 20. Okay. Net selling price is somewhere 35. The rule says that we cannot reduce below the carrying amount. Is it right? We cannot reduce below the carrying amount. Means we have to take the value as it is. Machinery. Is it right? Likewise, the impairment loss cannot set against non-monetary items. Non-monetary items should always be in full. Okay. Non-monetary items always be full. The balance of impairment loss. How much is the impairment loss? Impairment loss is 41 million. Okay. Goodwill, how much it is there? Goodwill is 13 million. Okay. Goodwill is 13 million. How much is left over? 28 million. Okay. 28 million. How we have to allocate those 20 million? We have to take this into consideration. What is there? This is over. This is over. No. How much is there if you take 49 plus 35 plus 14? 49 plus 35 plus 14. It comes to how much? It comes to 98. Okay. Check again. 49 plus 35 plus 14. Okay. How much? 98. Is it right? Now, what they say, very simple. It's very simple. Is it? I will write this here. 49 times 49 by 98. 49 by 98 times 28. Okay. 49 divided by 98 times 28. It comes to 14. 14 is right. 49 minus 14, 35. Next, 35 divided by 98 times 28. Is it right? 35 divided by 98 times 28. It comes to how much? It comes to almost 10. Okay. It comes to 10. And 14 is it? 14 divided by 98 times 28. It comes to how much? It comes to. Is it right? This is the 48 million loss, that impairment loss. 150 minus 49. What is the revised value? Revised value is 109. What it says, see that, test your understanding. factory explosions. Is it? There are the explosion in the factory. The carrying amount of his assets are like this: 100, 200, 300, 500, and 1500. The factory operates as a cash generating unit. An impairment review reveals that is net selling price of 1.2 million for the factory, and the value in is how much? 1.95 million. Half of the machines has been blown to pieces, but other half can be sold at least at the carrying amount. The patents has been superseded and now considered as worthless. Means patent values are zero. Okay, patent values are zero. How much is the net impairment loss? Is it? How much is the net impairment? They say that as per the draft. Okay, how much is the net impair? We have to know what is the net impairment loss. Is it? They say that machines have become worthless and patents will become zero. Is it right? Patents will become zero and machine will be carrying amount will be 150. Okay, carrying amount will be 150, 500, 1500. Okay, and yes. Okay, now how much is they said that value in use, how much value is in use is 1.95. Okay, 1.95. Now the difference between the carrying amount and value in use, is it right? The difference between the carrying amount and the value in use is going to be identified as a impairment loss as such. Is it right? Carrying amount is how much? Carrying amount is how much? We don't know carrying amount. Is it right? We don't know the carrying amount. You take this one. Is it right? This is 100. This is 500. This is 1500. Okay. If you take the total of this, is it right? If you take the total of this 100 plus 150 plus 500 plus 1500, carrying amount will be how much? You know, carrying amount will be 2250 thousands. Okay, in thousands. Value in use how much? Value in use is how much? Value is in use 195. Is it right? Difference of 300 thousands. Is it right? 300 thousands. Is it right? Is the impairment. That impairment, very simple. It's not difficult at all. Okay, it's not difficult at all. You should know the shortcuts. Now we have to think over the shortcuts. Okay, first write particulars. Is that particulars? Allocation of impairment loss. Allocation of impairment loss to cash generating units. Is it? How much it is given in the draft? How much is the impairment? Is it right? How much is the impairment and how much is the revised values? Okay, all are in thousands. Okay, all are in thousands. First and foremost, okay, first and foremost, goodwill will be targeted. Understand my point? First and foremost, goodwill will become nil. Okay, goodwill will that's the 100 is there. Impairment is how much? First it is goodwill. Okay, without any doubt as such. Then you will have patents. They say patents is also going to be. They say very clearly where it has been. The patents have been superseded and now considered worthless. Okay, how much is the patents? Patents is 0. Okay, patents is 0. Fine. Patents is the machines. How much is the value? How much is the carrying value of machines? Carrying value of machines are 150. Okay, carrying amount of machines 150. Half of the machines has been blown to pieces, but other half of the can be sold for at least their carrying amount. Okay, they can be sold at least on the carrying amount. Okay, computers. Fine. Computers. How much is there? Computers are 500. Okay, now computers are 500 and buildings are how much? Buildings are 1500. Total comes to 2250. How much is the impairment loss? Impairment loss is 300. How much already we have taken? 100. Okay, means we have the option to work out on this two only. The total of these two is how much? 200. Is it 500 divided by 2000? Is it at times 200? Okay, 500. It comes to how much? 500 divided by 2000 times 200. It comes to 50. It comes to 50. It comes to 150. Okay, as simple as we can understand that. 1500 divided by 2000 times 200, it comes to how much? 150. Okay, it is 450 and it is 1350. If you add it, it comes to how much? 1950. How much is the total impairment loss? Total impairment loss is how much? Total impairment loss is how much? We have patents is there, we have buildings is there, machines are there, and we have this 300 is there. Is that total impairment loss? Is that total impairment loss? How much is there? See, goodwill is there. How much goodwill? Goodwill is 100. Okay, goodwill is 100. Computers are how much? Computers are 50. Okay, computers are 50. Buildings is how much? Buildings are 150. Okay, buildings are 150. And patents are how much? Patents are 200. Is it right? Patents are 200. Next, machines are how much? Machines are 150. Okay, machines are 150. 150, 300, 500, 650. In thousands. Okay, 650 in thousands. This is the way we have to do cash generating units. It's easy, very simple. When I'm saying it's easy, it's easy. Okay, if there is any difficulties there, immediately I will let you know that this is a little bit difficult. We have to be very specific as such. What it says, they say that if no reasonable allocation of corporate assets or goodwill is possible, then the group of cash generating units must be treated for impairment in two-stage process. Okay, what they say means if we don't have any clarity as such, then we have to then the group of cash generating assets should be treated in a two-way process. Is it right? We have to say what is the step one is we have to talk about individually, and the step two is we have to compare the carrying amount as a business as a whole. Is it? Just I will explain you this. An entity acquires a business, 3 cash generating units, D, E and F, but there is no reasonable way of allocating goodwill to them. After 3 years, the carrying amount is of the net assets in the cash generating units purchased goodwill are as follows. What is the carrying amount? 250, 360, 420. Recoverable amount is 300, 400 and 360. Here the recoverable amount is more. Okay, here the recoverable amount is more. Here also the recoverable amount is more. Is it right? F is impaired. Is it right? F here the carrying amount is more. How much is the impairment? impairment is 60,000. Is it right? Impairment means it has been reduced to how much? It has been reduced to 360. Fine. Now, goodwill is how much? 150. Okay. Step 2. First, we have to take what is the individual components. Okay. Second, compare the carrying amount of the business as a whole, including goodwill recovery. What is the carrying amount? Is how much is there? See the things. How much is there? 1,170. Is it right? 1,170 minus 60,000. Is it right? Minus 60,000. 170 minus 60. Is it 170 minus 60? Okay. Now you have 170 minus 60. Right. Next, how much is the total of this? 300, 420 plus 360. Is it? Total of this is how much? This plus this plus this. It comes to this. Is it right? Now 1,170 minus 60,000. Okay, minus 60. It comes to how much? 1110. 1110 minus 1080. Is it right? 1110 minus 1080. Is it? If we take into consideration what is the further loss of impairment? Further loss of impairment is 30,000. Is it? If see what happens, in some case there will be a option to have a reversal also. The calculation of impairment loss is based on predictions. It's only than estimations. Is that we are doing only based on estimation. Sometimes actual events turns to be better than predicted. If this happens, recoverable amount is recalculated. And whether if we have done something done previously, we have written down, it can be reversed. Impaired assets should be reviewed at each reporting date annually to see whether indications of whether there is a possibility of reversal. A reversal of impairment loss is recognized immediately. We should not carry forward for more than a period. If original impairment is charged against revaluation surplus, always make it a point. First and foremost, we have to identify the revaluation surplus. Is that it is recognized as a OCI and credited to revalue. The reversal must take the value of the asset above the amount. Means if we are reversal must not take the value of the asset above the amount. Means it should not be more than the carrying amount. Okay. The depreciation for the period should be revised to reflect the carry. Means we have to charge depreciation based on the current position. An impairment loss for goodwill cannot be reversed in a sum. There are very, very clear conditions that has been mentioned here. Okay, very, very clear conditions has been mentioned. Fine, I'll stop here. When we come back in the next session, we'll start from here. Okay, thank you so much. Please subscribe to my channel and follow the sequence. Okay, and hope we'll come back with this question and we will complete the session chapter in the next session. Thank you so much.